Uber is off to a rocky start with its debut on the New York Stock Exchange. The ride-sharing company was expected to have one of the largest initial public offerings in years, but instead it opened well below the estimated range set by the company. A share of Uber closed on Friday at $41.57, down more than 7%. So CBS News business analyst Jill Schlesinger is here to break it all down for us. Now, I got to admit, I was a little suspicious about Uber because of what we know about the company, not to mention, of course, the earlier strikes, because the drivers are very upset about their pay. But what's going on? Why is Uber not doing as well as anticipated?
Well, I think that, first of all, IPOs are not exact science. So what's happening in the IPO pricing is there's two factors. One is the investment bank is hired to get all of those original shareholders, the founders, the executives, employees, you want to get them out, sell their shares to the public at the highest price possible. That was the $45 IPO. So that's where they got out. Okay, now you go into the next phase, which is who's buying those shares? And the question really became, do you buy the thesis that Uber is going to be the Amazon of transportation, or instead do you think that this is really the pets.com of this era, meaning that here's a company that's losing billions of dollars a year and it doesn't matter what they're going to get into next, they're never going to be able to make money. Most analysts believe just under current circumstances it would take them about a decade to make money. So if they turn out to be Amazon, the people who bought the shares down at 45, maybe they'll be tripled. Remember, Facebook first days of trading down dramatically, came roaring back. Yeah. So it's just a day, but it's a little rough ride for Uber.
Except Lyft, a very similar company, did the same thing several months ago and has been kind of flopping around ever since.
Yeah, in fact, Lyft shares down through Friday's close, about 29% from that IPO price. I think Lyft is in a harder situation than Uber. I mean, I think that Uber has Uber Eats. Uber is making other inroads into electronic and bike rentals, scooters. It's looking at autonomous driving. It's looking at freight. So Uber has bigger menu of things that could go right down the line. I think that the ride-sharing business is inherently a difficult one because these companies are paying huge subsidies to both the drivers and riders to get us hooked onto this service. Whether they figure out a way to make money once we are hooked remains to be seen.
And I think, you know, when you have an industry like this that's a disruptor, the mainstream industries fight back. And we've seen that with Uber. You know, in some cases they've been kicked out of cities. There's sort of been bylaws limiting. So I would think as an investor, I would know, you know, how survivable is this if suddenly sort of wholesale governments and the mainstream industries really sort of fight back?
Well, I think the real issue that both of these companies are going to contend with is whether the government and states and cities see their drivers as employees or contractors. Right now, they are classified as contractors. So that means these companies don't have to pay benefits. They don't have to pay into Social Security for them. There's no 401k. There's no health insurance. They don't have to pay their half of the FICA taxes. So that means that on average, these companies are actually milking their workers pretty well. If that category classification were to change, if all of a sudden a new government came into place, a new labor department said, they're not contractors, they're employees, then boy, you would see these companies get hit around like nobody's business. This is a huge risk. Both companies mentioned it in their prospectus IPOs, saying this is a major risk, the way we classify our drivers.
That's interesting. Okay, let's talk about trade, right? Because China had been threatening retaliation, and right before the show, they did that. $60 billion worth of American goods. We didn't know how that retaliation could look because they had other options besides just more tariffs. So let's talk about what this means. And it seems like when they ratchet up their tariffs, American farmers seem to be the ones that suffer. Yeah,
this is a tough one because there are already, so it's sort of similar to the U.S. The tariff was already in place on $60 billion of U.S. imported goods into China. But the tariff rate was quite low, somewhere between 5 and 10% depending on the product. Now China says we're going up to 25% on those imports, and that will take effect June 1st. Now, we already know U.S. farmers have been hurt very dramatically by this. I looked it up right before we got on the air. Farm income was down 16% last year in the United States. Soybean prices are at 10-year lows. Now, this is being offset just on a day-to-day basis because the government has created a pool of $12 billion of subsidies to help farmers. But if you're a farmer and you're a big producer, you don't want the subsidy.
No.
You want you want to have that market open to you, and you don't want this to be, okay, this is better for a year. What happens if the Chinese find a different source? And now I've lost that customer, and I'm counting on that customer. So not good news for the U.S. farming community.
Right. Oh, man. And it doesn't look like things are going to end anytime soon between China and the U.S. Jill, thank you so much.
Thank you.